So I'll just quickly cover a little bit unfinished theory part, okay, little bit, okay. So these are something which we have done already, okay. A strike price, we know what is strike price. Option premium, we know what is option premium. Market lots, we know what is that. Expiration day, we know. In the money, out of the money, at the money, doesn't require any explanation. So I'm just skipping that. Now, there are four kinds of people which I've covered: a call holder or a call buyer. He's also called call holder. When you buy a call, okay, so, there will be a call holder or a buyer. There will be call writer or a call seller, put holder or put buyer or put writer. So these are the four kinds of people who are trade in this thing. Is it okay? Then strike price we have already covered. Okay, so I'm not covering that. Now, a number of strikes, they are available. When you open, you get strikes, contract trading cycle, so you can choose your month. Mode of settlement, cash settlement, which we have already covered. So, all the currency future forwards, currency options and futures, they are all cash settled. Now, there is American and European options, okay? Which I told you that in an American option, you can exercise your call anytime you want. But in case of European option, you have to wait till expiry. And we'll understand how to exit a European options more later, not today. Factors that determine the option premium. So this is very important. Now the premium, you have to pay a premium. Okay. So what are the factors which determine the premium? First is the price of the underlying. As the underlying price rises, so does the premium. So price of the underlying is the spot rate. The spot rate is rising, the premium will also go up for that particular. आज premium कुछ है, अगर spot price बढ़ेगा तो उसका premium बढ़ जाएगा या घट जाएगा. Volatility of the underlying. How volatile is the currency pair or a stock? Okay, fine. So here I'll just show you, okay. So this is called Sharpe ratio. You might have done Sharpe ratio in your life. No. Anyway, we are not doing Sharpe ratio, but I'll just explain you in the process. Now, just look at this. There are two stocks. Now we're talking about stocks, not the currency, okay? So there are two stocks, stock X and stock Y. So assume that there are two stocks, okay? Stock X and stock Y. And suppose there is a fixed deposit also, okay? Fine. And suppose there is a risk-free rate. Okay, risk-free rate is that if you deposit your money in a government bond, which is considered the least risky investment, okay? So currently it's around 7.16 or so. I'll show you the window from where you check the rate. So it's assume I rounded it off to 7.25. It's hovering around that number. Government borrowing rate.
What duration? 10 years or 11 years?
Yeah. So here what we do is we look at the 10-year bond rate, because when we are just looking at the stock market, then longer the duration, better it is. So now the government can issue for 20 years bond, 30 years bond, 10 years. But since the stock information is limited, it's not available for 30 years or maybe like that, or maybe whatever reason. So 10-year bond paper is considered to be sacrosanct for analyzing the stock, to correlate with the stock. Okay, because all the information is deeply available for the stock market in the last 10 years. So that's why we stick to the 10-year bond. It becomes our area of, it becomes the yardstick from where we look at. So today, if you put a money in a government paper, you get 7.25% return. Now let's come back to the stock A, stock X and stock Y. Okay. Now stock Y, this is the years: year 1, year 2, year 3, year 4, year 5, year 6. So this is what the stock has given return. First year 20% positive. Next year 20% negative. So it can go up and down. Next year 32% up. Okay. Then 20% down. Then 30%, 5% up. Then 24% up. Okay. The mean return is 22%. The mean of everything is 22%. Okay. Fine. So I've calculated the mean. So if you look at the formula. So there's no formulas. Okay. So what I'll do, I'll put average here. And close the bracket and make, everything here. Okay. And then close the bracket. So my mean return will also change, comes to 12%. So there was a mistake there. So here it is coming to 10%. Okay. So this is the average return. Is that okay? Fine. Both the stocks are giving, this stock is giving you 12% average return. This stock is giving 10%. Only this information given. Now, we always believe that whatever is the historical return average, so the stock is going to give you that much of return if you hold the stock for a longer period of time. Of course, derived from the past data. Okay. But you're trying to link it to the future, that this is the return what you're going to get. Okay. This is normally there. Okay. Now it is based on historical. Some people can question it. Okay, history में जो हुआ था अब वापस repeat तो होगा नहीं, but this is the mean return what you are getting. Now there is another way of doing it. Another way of doing it, of course, we can't do it futuristic, but we can do what has happened in the past. So we paint three scenarios. One is a boom time, another recession time, third is a normal time. And look at what return each stock has offered during this time. Okay, and assign a probability to each scenario. And you calculate what is the mean return. So that may look a little bit more that what is the chance of the boom, what is the chance of recession, what is the chance of normal period. Okay, and look at the history of the stock and pick up historical averages, how much return in boom time the stock has given to you. In recession it is given. So you can even calculate historical return, average return on that basis also. Okay, but nobody can tell the future. So you have to rely something on the past and something, been predicting a scenario. Okay, so let's cut short. That means you are going to get 12% return if you invest for a long period of time. Here 10%. Of course, this is valid only if the company characteristics doesn't changes. Company is doing the same kind of business. If the company business changes, like for example, Reliance, they have moved up from textile to petroleum to now a sixth kind of business scenario, and they're giving more focus towards retail businesses and other things. So it's chances are they're going to give better return in future. Okay, fine. So that can change. The mean return can always become meaningless if the company's characteristics have changes. Then you can say, okay, it has given 12%. You can rely on last 3 years numbers or whatever to make it more realistic. Okay. Some people say 10 years, but 10 years too long. Okay, things might have changed. Company has become, a different company today. So this is 12% and this is 10. So these two numbers are given to you. Okay, and you want to know which stock to invest. So which stock you are going to invest only on this base. The stock X, because it is expected to give you a kind of 12% return. Now, the second information before you make a decision is a standard deviation. How volatile is the stock? The more volatile, more risk it is. More risky it is. Okay, fine. So you look at standard deviation. So you calculate standard deviation. The formula is, I've used the formula here. So standard deviation is 23%. Look at the formula there. And here it is 3.4. So which is more of volatile, stock X or stock Y? X is more volatile. Okay, fine. So let me just make it a little bit more. Let's make it, 25% return here. Okay, and make it 9% here. -9 था यहाँ पर पहले. चलो अभी हमने इसको -9 ले लेते हैं. Okay, but I want this return should go up a little bit. इसको 14% ले लेते हैं, इसको 16% ले लेते हैं, इसको 16% ले लेते हैं. फाइन, लेट मेक इट 15%. ओके, सो अभी भी कुछ ज्यादा मूव नहीं करेगा. एनीवे, नाउ द टू स्टॉक्स आर गिवन टू यू. Assume the both are giving 12% mean return. Okay. Now, before you decide which stock to invest, look at the stock which is more riskier. This stock is more riskier because the standard deviation is 20%. Chances are it will go up and down more. This stock will give you a steady return. Now, companies like Hindustan Lever, they have lower standard deviation. Companies like, airlines companies or which are more in consumer destination will always have more volatility because there will be more cycles. It's a cyclical stock. More cyclical stocks will have more standard deviation because they're bound to be more volatile. Okay, fine. Now, if you have these two numbers, then you can decide very easily that this stock is better because this here you're getting 12% return with low volatility. Okay. Now, this is called the volatility. Okay. So this is the historical volatility of the stock. Okay. Fine. This is what the historical, the last 5 years, how volatile is the stock. Fine. So I'm not going to the Sharpe ratio at the moment. Otherwise, I'll go sometime later. Okay. Okay. So this is the volatility. Now let's come back to this. And there is, what I have done is volatility of the underlying historical versus implied. Okay. Fine. Do you understand this? No. So what we do is that you just open this. Is this there? This thing. ये दिया हुआ मैंने इसका लिंक दिया हुआ आपकी स्लाइड्स में. Anybody? So I just go here and go to this site. Okay, so this is implied volatility. Now we know that this stock is, suppose we choose this stock, where the historical volatility is 23%. Okay. Now we just, go to this site. Okay. And suppose we are buying a call option. Okay. Fine. So what we have to do is we have to enter certain numbers here. What is the strike price? Suppose it was 102, I think. Okay. Or 103. Suppose the strike price is 100. I'm just explaining the concept, not going into detailing at the moment. But when we do the stock, this thing, we'll do it a little more detail. Suppose the spot price is 103, strike price is 100, interest rate, risk-free rate is 5.5%, and time to expiry is 30 days. Okay. Then the premium is 1 rupee 90 paisa. So then you calculate what is the, please check the market price vis-a-vis spot price entered. कुछ गलती हुई है.
Price should be.
Okay. मैं दोबारा से करता हूँ. I'll look at the default. Okay. Okay.
1.9 is the market price.
Okay. So look at this. Okay. जो इसका हमने वो ले लिया, हमने अपने खुद डेटा पंच नहीं करा. The figure it was given. So we find that implied volatility is 14.9%. That means this is the premium. 1.9 is the premium the writer is charging. So this is the spot price. This is the strike price. Okay. Assume it is at the money. And risk-free rate is 5.5%. Time to expiry is 30. Okay. And the premium being charged, when you buy this stock, you are paying 1 rupee 90 paisa premium. Okay. So he says how much volatility has been built by the option writer. Then you check the stock, the underlying stock. The underlying stock is suppose this. Suppose this is stock Y. What is the volatility? 10%. What the premium writer has built in his premium, in this option premium? 14.59. Okay. So he has built more volatility into the premium. Suppose the volatility goes up. Now suppose I say the premium, instead of it is 1 rupee, it is 2 rupees 90 paisa. The volatility goes to 23%, isn't it? इसका मतलब जैसे प्रीमियम बढ़ रहा है, he is building more volatility into the pricing. Stock is only 10% volatile. He is building 23.39 and he is jacking up the premium. Fine. So the stock is not going to move to 23%, but he is assuming that it will move 23%. So that means he is charging you, overcharging you. Just understand, he is charging you much more than what should have. Actually, what should be the right premium for this? Let's say it comes to 1 rupee. It should be 1.2. So let's do some iteration. Sorry. So it can be, the right price should be, we are just trying to make closer to the historical volatility. Okay. It comes to 10%. So the right premium should be 1 rupee 40 paisa. Okay. If he's charging 114 and the historical volatility is 10%, that it is rightly priced. Okay. It is neither overpriced nor underpriced. Suppose it happens to be 1 rupee 90 paisa, then the volatility, the implied volatility is higher. So that means the writer is in a good situation. He's charging you extra. So instead of buying a call option, you should write a call option, because the chance of making more money is more, because I'm just repeating. थोड़ा इसको और अच्छी डिटेल में करेंगे जब स्टॉक में जाएंगे. Just to give you a flavor of that. Now the premium is there on the screen. When you look at the premium, this is the premium. Then you want to know whether it's a right premium or it's a overpricing, because you may take a position only where the premium is less. You don't want to pay higher premium. For any given strike, you want to pay only the premium, which should be the right premium. So there was a guy called Black-Scholes who given a formula that the premium depends upon a lot of things. One thing is volatility. Okay, fine. So you check how much volatility has been built into the option premium. So this is the calculator for that. So when you found the screen, it was 1 rupee 90 paisa, which means rest of the things are given to you. Only volatility is the missing factor. So he calculated the volatility here. So he says that the premium having an implied volatility of 14.59, whereas the stock can move only 10% plus minus. Okay, fine. If it moves one standard deviation, it will be plus minus the volatility. If it moves, there is a something called normal distribution, you might have heard. So one standard deviation is 67% chance that the things will move into 1 plus minus volatility, and 97% chance it can move 2 standard deviation, and 99 3 standard deviation. Okay, so we'll understand that more in detail little later, maybe next class. So 14.59 volatility he has built in. So here he's assuming the stock is more volatile, whereas stock is very less volatile. Okay, stock तो इधर उधर नहीं जाएगा. स्टॉक तो मेरे ख्याल जितने का स्टॉक है 100 रुपए से और 102 रुपए के बीच में ही होगा, इधर उधर चलेगा. वोलेटिलिटी कम है. अगर वोलेटिलिटी ज्यादा है, लुक एट दिस स्टॉक. This stock is going all over the places. Sometime 20, sometime minus 20. So this stock is very volatile. The more volatile the stock, chances are that the call buyer or a put buyer will make money. है ना? जैसे ही आपके फेवर में जाएगा, आप क्लोज कर दोगे position and you will exit from this thing and make money if it is more volatile. So the call writer or a put writer doesn't want to give you that chance. What will he do? He will increase the volatility. The cost of premium will go up, which will means that he has built in 14-15% volatility. The stock is not that. He's charging you more. Fine. So what you should do, stock is not going to move. Okay, so you should actually, instead of buying a call, you should be writing a call. Because here, the premium is 14.59% volatility. Now, when we found that the volatility should have been only, the premium should have been only 1.4, then it was 10.7, very close to the volatility of the stock. If the volatility of the stock matches with the implied and historical rate are same, that means this is the right price of the product. Okay, assume that you have gone to the market to check the price. The price should have been 1 rupee 40 paisa. Okay, and it should be one. How to check that? It should be right one. To check the volatility in case of the market here. So when you check the volatility, the stock is matching with the historical and implied is same, then you say this is the right price. Otherwise, if he's charging say 1.90, let's say he's charging say 2 rupees, then the volatility is 15%. He is assuming the stock to be more volatile, which is not the case. Okay, because higher the volatility, the premium will go higher, because the option premium will be option writer will be always a fear that ये stock तो बहुत volatile है, so I should charge more premium. So he's building more volatility to charge you more. Okay, so he's charging you assuming that the volatility stock is 15.47, whereas the stock which you are going to buy has a volatility only 10%, isn't it? Have you got this thing? ये समझ में आ गया नहीं? Is that so? अभी तक इतना ही है. Okay.
How does the writing of the options help in this case?
Writing. I told you that if the premium is higher, suppose if you check the price is 2 rupees and you think the 2 rupees is very high price, you will buy from the market at 140, which is the right price, and sell at 2 rupees, isn't it? You will do that. Instead of buying the product from the market, instead of becoming a customer, you will become a supplier. अगर कोई चीज आपको 2 रुपए में बिक रही है मार्केट में, आप देखते हो कहीं पर कि वहां लोग खरीद रहे हैं, तो आप कहीं से 1 रुपए 40 पैसे में खरीदो जिसका राइट प्राइस है और 2 रुपए में बेच दो, तो इसलिए यू बिकम अ राइटर. Is that okay? That was the right question. I mean, this is apt for that. Is that okay? So if the price is very high, you become a writer. You will be in a gainful situation. Is that okay? So I'm just closing this now and moving to the stock